Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, September 26, 2023. Markets are now closed, and I want to do, I want this to be pretty concise and straightforward, this video. There are, I think, a lot of important things, and it will not be, I always say that, and I'll try to make it not a super long video. I'm going to hit on probably the most important things and the most important levels and current and potential developments to watch for the market. Okay, we'll keep it simple. I'm going to look at the indexes because that's where we usually start. I'll stick with the large caps, kind of keep this thing streamlined. You know, we can go into small, mid caps later on, do that different. Large caps, that's SPY QQQ. Any analysis thereof is incomplete in my opinion without going over the Magnificent Seven, the big market leading tech stocks. So we'll hit those real quick because a lot of those, and I wouldn't cover them if there weren't significant developments to note there as well. Just like QQQ, which pretty much parked, effectively right on key support today, a hair below, but again, I've always said if you have to squint, then it didn't take out support. So we're closed on there. So I'm going to cover where the market leaders were. A lot of them fell to support, and then the financials. So really I want to cover the indexes, tech, just via these top, the stocks that make all the difference. Those top 7 account for over half the gains of the NASDAQ 100 and a big chunk of the NASDAQ or S&P. And we'll look at the semis maybe as well. I'll talk on treasury yields. Remember, I covered that before. In the video earlier today, I talked about how, a lot of those yellow flags, maybe even some may soon be red flags. A red flag's just more of a yellow flag's warning and red's caution, just more severe typically. So we'll watch those things such as, California muni bonds and corporate bonds and junk bonds and treasury bond yields and oil prices continuing to surge. Again, maybe I'll touch on that time permitting, but this video here's what we're going to do. We're going to look at the indexes, look at the tech and semis, look at some of the financials. Not all of them, just some of the big banks and major financial companies. So we'll keep that, just those two, really focused on those two sectors. Because although tech is the largest, even in the S&P 500, of the 11 sectors that comprise the S&P 500, tech is by far, without even a close second, the biggest weighting, and it's over half of the NASDAQ 100. So I've always said, you just need to know where the tech stocks are going, and you know where the whole market's going. It's literally that easy. However, where we're at, and this is not, 99% of the time, it's not really a thing. Right now, I think it's very important to watch the banking sector because although it doesn't carry the weighting that it used to, the entire financial sector, it could have, if problems there could be catastrophic for both the stock market and the broader economy as well. So we need to watch those right now, even though the financials, again, don't have as big a weighting in the S&P, and there's zero weighting in the NASDAQ 100. So now you might say, well, Randy, you said you typically trade the NQs, the NASDAQ 100 futures. I do. Why do you care about the financials? Again, because if the banks, especially the big banks, JP Morgan, or there's, a lot more problems in the regionals, that affects everything. It affects lending, credit tightness, which then has a direct effect on the economy. And, all those big tech stocks are growth companies. They don't like a slowing. They want a growing economy. They do best in expansion mode, not contraction mode or recession. So that's why the banks are important, whether or not I'm trading them. Before I get into the charts, let me go into here. I like to, from time to time, go address some of the questions in the comment section. I really appreciate those. There's no such thing as a stupid question. I tell you that right now, especially in this. There's a lot to this whole thing. And when I see, especially when I see the same question put to me twice, then I know it's probably quite a few other people have that concern or that question. And so I want to start out here with this one. Here was a comment that came in saying big positive divergences on the QQQ 1-hour chart and very close to 354 support. This is typically where you like to go long. Absolutely, that is a very accurate statement. That is typically where I like to go long. Not always, and I'm going to talk on that. So let me read my reply, and then I'll expand on that a little bit right here. And of course, you can go in and check this too. So true, meaning yes, correct statement. I may cover index shorts and reversed along soon, but for many of the reasons covered in the video and I'm referring to the one earlier today, previous video, I'm sitting tight on my shorts for now, as I think there's a fair chance that the key support QQQ is currently testing will be taken out soon. Lots of key stocks and sectors are rolling over and triggering sell signals recently. Plus, so many of those yellow and maybe even some red flags out there in niche areas such that the masses aren't aware of yet. And again, I go off that because I look at headlines and, occasionally turn the TV on, rarely, but occasionally. And I'm just not hearing that being a thing. And maybe I'm seeing things that will, won't end up being a thing, like the California muni bonds I've been talking about, the REITs that I covered today melting down. I'm watching the regional and mega too big to fail banks. That's your JP Morgans and Citi and the likes. Visa, MasterCard, Amex, covered those earlier today. Crude oil, surging crude oil prices and treasury yields soaring to new 52-week highs. I'm watching the employment-related stocks. The market waits every week to see what the weekly and monthly employment numbers released. They look at jobless claims and all that good stuff. I'll look at the ADP, because if there's problems in the job market, the insiders know. That's there's legal insider trading. If you work for a company, as long as you're not telling, you're not acting on non-public information, but the insiders, the executives of the company that have large amounts, they're typically, you see a lot of insider buying when the insiders are bullish on a company, and a lot of insider selling, taking out their some of their shares when the outlook's not so good. So you can often see those stocks turn before the market turns. And so those are some of the many, many things I'm watching. So here's what I went on to say. If the bulls want to see new highs anytime soon, they really need to step in here and start undoing some of those recent breakdowns. Again, I'm talking about breaks of support. I'm not betting on it, but I will react and adjust my position accordingly if that proves to be the case. Until then, I'm remaining short, especially on my swing and trend trading accounts. Those are my non-active trading accounts. Okay, I have to always throw that out there, because I'll post a 5-minute chart, and I'll, in a downtrend, I'll game the cues for a counter trend, if I'm short, and, overall, in my swing and trend positions and longer term bearish, as I've been for a while, I'll, go long, short all day long within there, my active trading account. If I can game a 1% bounce, even a 0.5% bounce, and you buy, cover your NQ shorts and buy some, some go long those contracts. It depends how much you're trading with, but you can be making thousands of dollars in a day and averting thousands of dollars of losses. So why not? Anyways, that's that. So I try to differentiate that. And I've always said, if anything I post on a 5-minute chart, 15-minute chart, that's not bigger picture stuff. If you're 401k, if you're part-time investor, swinger trend trader, just disregard that stuff and focus, really, I always say, on the 60-minute daily and weekly charts. All right, so there's some other things. I answered palladium and natural gas. I give an update there on natural gas. The other one, here it is. Okay, so I'm confused. Market may bounce, but it could just tank also. Yes. And again, you may spin that as double speak, but I'm clear on my positioning. I'm just saying, as I said down here in my reply, I'm basically driving with one foot on the accelerator right now, short, but I've got the other foot just hovering above the brake pedal, and I'm ready to, either recover, reduce, or even maybe hedge up or stop out. Because that's it. When you come down to a key level like this, like I said, this is where the bulls, quote unquote, should be stepping in. They need to step in, and they may step in. I'm going to go over those levels here in just a second. So again, I hope it's not confusing. One analogy I'll give you, one of my favorite movies, most of you probably seen this movie, Heat. I can't think it came out in the 90s. And it was, if I recall right, it was the first movie that two of the industry greats that had concurrent careers, Pacino and De Niro, were in together, and this is their first scene together. This is where Pacino, the detective, homicide detective, pulls De Niro over, and he's the not petty theft. What do you call it? Organized. He's a high level thief. And anyways, they sit down. So this is a scene that I always think of in trading, and I'll just play what he says. You guys probably remember this scene.
Guy told me one time, don't let yourself get attached to anything you are not willing to walk out on in 30 seconds flat if you feel the heat around the corner.
Okay, so that's always been kind of one of my overriding mantras, if you will, in
you gotta move on.
Trading and investing. And it's the whole don't get married to your position. Sometimes you might have the highest degree of confidence that a stock or an index or sector is going to do this or that or the other, but it goes the other way. And so now we'll get into the charts, and hopefully that'll make sense. So again, you do this long enough, and it becomes a lot more easy to just throw a hand away. I'm using a poker analogy, and the same thing. That's the only gambling I do outside of gaming the stock market is poker. Love poker, and if you really get good at it, that if you have playing Texas Hold'em and the turn card comes down or the river card, and you're beat, you throw that hand away, even if you've got a lot in the pot. A good player will fold that hand when he's convinced that he's been beat, and the same thing in the market. So hopefully that makes sense. So yes, the market either going to go up or it's going to go down. As I've said, if we can clearly get down through there, we closed right on, for all intents and purposes, right on that support level. I've always said, if you have to squint to see if we broke down or you break out, then you didn't break out. There's where the candle right there, closed at 354.22. That support level, the reaction low from August 18th was 354.70. So you're talking less than 40 cents, 38 cents on a 354-point security. So now you're talking a fraction of a percent there. Okay, so for all intents and purposes, the market's closed on support, and not just QQQ. SPY did break down, I'll give it that. SPY broke down, clear breakdown, so this is one reason. The S&P 500 is clearly below my red line now. The uptrend line, so that one is a check mark there, an additional check mark. Remember, it's been, to me, nothing but additional check marks, increasing the odds of my longer term bearish scenario with each additional breakdown, and this was another check mark. However, QQQ did not give me that check mark today, nor did a lot of the market leading FANGs. We're going to go into those right now. So again, we're going to say that's a close, that board, no, that's the one that has it right there. So close right on support for QQQ. Apple. Okay, Apple actually closed. I had my line right here at 170.37, but there is the low from August 18th that's comparable to that level on QQQ, and that's exactly where Apple closed as well. I just had the support level a little bit below because of all of these reactions back here. Right below that is the 200 exponential, the 200-day simple. This is the crowd favorite. This is the most beloved stock in the world. It's the most profitable company out there. I don't, Saudi Aramco, I don't know what the numbers are, but in the U.S. markets, by far. And so, how many Apple diehards are going to want to step in here? You have the stock down now, 14% off its highs. Sorry about that. I had to hit the mute button so trading platform wouldn't keep talking to me. That is, okay, so a whole confluence of support right there. And this is why. This is what I'm talking about. There's a lot of evidence that tells me to be short, stay short, that these levels may go, but they haven't gone. And if Apple can rally anywhere from where it is now, because it closed, or today's low, closed on the lows.
Market data connection reestablished.
And it's right there. That's equal lows. That's your divergence line. When a price on a security is making equal or lower lows, it doesn't matter, equal or lower lows, and your indicators are making higher lows, which they are, your moment, that is positive divergence. And so, yes, I may be long and strong tomorrow. I'm going to show you some things that are probably going to make the difference here. I'm going to get to the economic calendar in just a second. But first, I want to give you these levels. However, with a lot that I see going on, and based on where we are in the whole scheme of things, I still put decent and even slightly favorable odds that we're going to break the support. And then ultimately, and that's where it's really time for me to get aggressively short. If and when all these divergences are taken out. If we just smash down through there, I would be surprised but not shocked to see Apple go through the 200s like they're not there. Possible. And if we do, then we'll probably rally up and back test them, and that'll be an objective short. But if and when these divergences are burned through, meaning these indicators, these momentum indicators take out their previous lows, that is a time, in my opinion, and not just Apple, collectively. I want to see it happen on a lot of these. As of now, it hasn't. And as of now, all I can tell you is we have positive divergence with a lot of key stocks coming up on support levels that I think will go. But maybe they go 3 weeks or 3 months from now after a rally first. Or maybe they go this week. I don't know, guys, but I'll react to it and either add to shorts or cover those shorts and or go long if I think a bounce is coming. Microsoft, this is a beautiful level. I've had this line here forever and a day, 311.56. It was reactions here and this reaction low. Again, there's that big old, keep talking about it, August 18th low. A lot of traders are going to be looking at that reaction low. Look, we closed right on it. And then you have the 200-day exponential and simple moving averages just below it. But if this level goes, my next price support level is all the way down here to 293.60, and that has the potential. If we do that, that would bring you down to the 200-day simple moving average as well. It has the potential to burn through these divergences. We'll see. It depends if and when we get there. You can see the RSI is right now at about equal lows. If it goes much lower, you won't have any divergence on the RSI. Okay, so that's it. So this is the second largest stock in the NASDAQ 100 and S&P 500, also at pretty significant support level, also with potential. I like to call these potential divergences, not confirmed. I confirm the divergence. It's just something I made up years ago. When the PPO makes a bullish crossover, in my opinion, that's when the divergence is confirmed because you've effectively put in a higher low. There are momentum indicators, and the momentum indicators are pointed lower now with no signs of a reversal. So it's what I call potential divergence. So we'll watch. And, it would actually surprise me if they didn't slightly undercut it just to blow out all the stops on longs and suck in some more shorts and then reverse. So, really want to see us get away from that level, especially a solid daily close down below. And then you have the 200s to contend with. But my next price target right there, other than the 200s again, which we'll see. We have to look at that collectively and see if all these stocks are falling to their 200s or other price support levels around the same time. Alphabet, just a big old support level right here. You had support back here before everything broke back in early 2022. And then fast forward here, you had a trading range. That was the top of the range. You had a rejection off that level again, and then a gap away breakout, back test, rally, and we're back testing it now. That is a 10, folks, on my opinion, a 10 on a scale 1 to 10 for support level. Very important support level. Bearish if broken, but the bull should be stepping in here. Why do I think it will break? Whether they step in, and get a little rally first or not. I gave you some potential bounce targets the other day. There's a bunch of gaps overhead on a lot of these NASDAQ stocks right there. So that's a potential target. So, whether we do that, that doesn't shake me out. Anything much above that shakes me out of these short positions. But based on the scope of this big bearish rising wedge and how frothy this rally got and how this market tends to work, it usually doesn't let the longs out or the shorts in when it decides to finally make a turn. Just like at the bottom, this bottom kind of pounded out here a little bit, but once, here's an example where you had a breakout. There was nice resistance, a trading range, and boom, once there was a breakout, there was no going back. It just shot up, and it got to this point before it started seeing some profit taking. All right, so again, what am I showing you? I'm showing you levels. I don't think I have an alert set there, but now I do. So I want to see these levels get taken out, and either a big intraday drop where it looks like you're almost guaranteed to close below, or get a solid close below. And again, the more that break down, I'm talking about Apple, Microsoft, Alphabet, the higher the chance that breakdown is going to stick. Amazon already broke down below this level. It's at pretty good support. I have a purple line here, 126.37. Pretty good support right there. So this is it. I sound redundant, but a lot of these market leaders are at support. However, the takeaway for me is they've all just recently, just freshly broken down below support and rolled over off these divergent highs, many of which ran into resistance like Amazon here. So based on that and the scope of these divergences, again, whether we get a little kickback rally first or not, I see more downside in these guys. And as of now, I'm staying short. It may change this week. I'll go over the economic calendar in a second. NVIDIA, big one to watch. Again, this is just, if this one rolls over and if it goes on to hit these targets, which I suspect it will, minimum 317.72, that's the bottom of this gap down here, and the uptrend line, you're talking another 24% drop. The stock's already off its highs by about 20%. That's going to put pressure on the tech sector. It's going to be, it'll be a psychological blow to the bulls, especially all those, caught up in the AI hype. Again, watch it. Otherwise, look, here's NVIDIA on a downtrend line. I'll give, there's something for everybody here. Bulls want to see that get broken out. And maybe NVIDIA runs up and makes a new high. And if it does, I'll tell you what, it's going to be a marginal new high, one that I'll probably be looking for signs of a reversal, maybe some type of bullish reversal, candlestick reversal pattern, or something of that nature. But as of now, I'm considering this the top. Okay, and if we break out and the rest of those stocks that I've been covering, not just NVIDIA is only going to go so far. This I promise you, it can only go so far without Apple, Microsoft, Alphabet, Tesla, Meta following it. So that's what I'll be watching for. So if I were to see that scenario happen, and NVIDIA somehow gets up there, puts in a marginal new high, and Apple, Microsoft, Alphabet, everything else is falling, continue to break support, I'll just start scaling into NVIDIA short, knowing that the weight of the market, the fact that it's indexed and it's a top, it has a high weighting in the NASDAQ 100, eventually that selling pressure from money coming out of the index as redemptions from QQQ, selling of the NQ futures, that'll bring NVIDIA down as well. Tesla, there it is. So a lot of these, again, Tesla's at support too. I didn't add these levels today. They've been here, 241.28. It's a pretty good level, nothing great. It's still below trend, the primary trend line that is. And so that's the story of the market leaders. Meta needs to take out that low right there. Is that also the, yes, it is the August 18th low. Those are the levels I've been harping on. So once all the fangs take those levels out with conviction, it's going to further increase the odds that my targets are going to be hit, my downside targets on QQQ and all these others. As of now, again, as I like to say, support is sport until unless broken. So is it that all-in moment? No. Was today a day to, if you had no positions, to start shorting, especially towards the end of the day? No. You don't short at support. TA 101 says you either buy a pullback to support or you wait for that support level to break. So as I just showed you, not only QQQ, but the majority of the market leading Magnificent 7 stocks all fell to and closed at support today. And I shared my thoughts that I suspect that support level will go, but if it doesn't, then we could rally. Now let me show you what to watch for this week. Okay, so why was the market down today? Well, we had consumer confidence. Consumer confidence, I don't put a high weighting on. A lot of it gets tracked a lot, talked about on TV, but it is the single most coincident indicator I've ever seen. There's no predictive value. It tends to go up and down with the stock market. Again, I've done this a long time. Stock market rallies 30%, consumer confidence is going up. Stock market drops 10, 20, 30%, consumer confidence drops. Why? Because someone's 401k and their investments, and even the Reddit crowd with their meme stocks, they're falling too. So anyways, that came in. Consensus today was 105.8. Number came in below the low end of the consensus range. I think, well, no, you can't see it in the video. There it is. Consensus range was 103.5 to 107.2. We missed that, even the low end, well below consensus. And maybe that'll be cited as one of the reasons. To me, it's more technical, but that's certainly something to note. New home sales. I won't go through each and every one. Actual came in at 675. The consensus, so that was actually at the very low end of the range. The range was 675 to 720, so we hit the low end of the range below consensus. So that was today. Remember, guys, you have a link to this economic calendar on the site under resources at the top menu. Click on that and then go down to tools of the trade. So here's what we're watching tomorrow. Big one, durable goods. Let's talk about that. So these are the things that are, I think, going to either make or break this support level we fell to, and this is why I'm ready to, if need be, pivot. I already reduced some exposure, just in my active trading account at the close today. I've added on the swing accounts earlier today, but then at the close on my active trading account, took a little off, and I'm going to set stops before I shut down for the day. In case things go the other way tomorrow, so I'll just leave, still have, decent, short position there, but nothing crazy because of all the stuff on the economic calendar tomorrow, and again, because of the fact we closed that support. All right, tomorrow, durable goods, new orders month over month. The consensus is for a drop of 0.3%. The prior was a pretty big drop. This is showing me what I've been talking about for a while. Economic indicators are starting to roll over, and watch this. So we'll see. There's your consensus range. That's one that has the potential to move the markets, and then you have big old GDP and jobless claims on Thursday. I'll let you guys look at those, look at the consensus. We'll talk a little bit about this. Jobless claims, the employment market, as I've talked about earlier, that is the one last, and it was always in a bull market, the last shoe to drop in an economic expansion. That's the last thing to buckle. We've already had the inverted yield curve for some time. A few weeks back, I misspoke because I listened to somebody else. My mistake. I didn't verify it. They said it had re-inverted. That's usually when the recession in the bear market is in full swing, when you get the re-inversion of the yield curve. But as a couple weeks ago, I said it did that, and it didn't do it yet. But it will soon, and then we'll get that's what historically has happened. Again, it's not the inversion that begins the bear market or the recession. You can pull up. I didn't have that chart queued up, but you can look at that. The inversion comes quite a ways before the actual recession comes. All right, so jobless claims, that's a big one. Consensus is for 211,000 new claims. Range is from 205 to 225. Prior was 201, so you see that ticking up. Let's see, I'll get to that in a second. I think I had it right here. Yeah, here's jobless claims. There's a chart. This is trading economics. You can Google these, they're all out there. You can see it's been ticking up. If I had a moving average line on here, you would see it would look something like this. You can see we're trending up. There's seasonality to this, of course, but you can see that this has been trending up, more recently down. So you watch for a spike up. And again, where are we at on that? I just showed you. We were at the consensus is for 211. There's a range, and that would put us up here. So anything, if we even hit consensus, we're going to have a tick up on that bar there as well. So let's keep an eye on that one. And what else do you have? This is something I mentioned to somebody the other day. That from a fundamental perspective, I said take a look at the Schiller P ratio. I just botched it all up. Let me go to all here. And never mind, I had another one that showed, there it is. How hot we are on that, and this is the current Schiller P ratio here, where it was when Black Tuesday hit, and that was the great, and this is comparable to what I see coming, to the U.S. Not the whole as bad as the, Great Recession or the Depression, but, similarities, if you will, in the economic conditions here. And that's where we were back then. And, normally this is what did it. Black Monday, that's where we were. There was the dot-com bubble. Things got ridiculously insane with the dot-com bubble because remember, that was just a bunch of companies with no earnings, no business model, no proven management. Everybody was going crazy for anything with the name .com in it when the whole internet craze was just getting going in the 90s right there. Anyways, you can see, so we're at nosebleed levels. And then kind of my whole overriding, theme here is that, the great bull market that we've had for the last, 4 or 5 decades was due to a secular bear market in interest rates, which is, in my opinion, and not just in my opinion, by most technical metrics, clearly over. Here's the 30-year, the 10-year Treasury bond. There's where rates peaked in the early 80s. This is your, I could put on my trend lines, but you can see there's your secular downtrend line, your bear market downtrend line, falling rates. They were natural, we call it naturally, central bank, a lot of, central bank walking it down. And then you had these spikes down during the financial crisis right here. These were rounds of quantitative easing. And then that's when the Fed pulled out the old nuclear option when COVID hit. But by all metrics, we've broken out below the trend line. This appears to be the early stages of a new secular bull market in interest rates. Not going to go straight up. In fact, I have us going down first and then up later on. And again, this happened over decades. So this, that's why I think we'll see a trend in the years to come of rising interest rates, and there'll be plenty of bull and bear markets within there. So there'll be tactical trading opportunities for bond fund investors, maybe even 401k investors that might want to ride out a counter trend trade or a primary trend trade in those. And so I think it'll be more of a trader's market in bonds going forward. And the bottom line is, it's economics 101, business school 101. Falling interest rates is bullish for the stock market and for the economy, lowers the cost of capital, and it lowers the attractiveness of fixed income investments. Mark my words, and we're seeing it already. We have 5.5% plus CDs out there right now. And when if I'm right, and we work our way back up to historical average rates, where you had 6-7% CDs and government treasury bonds, you're going to have a lot of money coming out of the stock market, out of a maybe, if I'm lucky, I'll average 10-12% a year investment, but I can lose 50 plus in a bad year, talking about your S&P 500 index fund, into, I can get a guaranteed 7%. It's just something that's happened throughout times in the market. So this is why longer term, I think it'll be a slow draw. And, entering and again, you can see the drop there in rates, and then you just compare that to the S&P 500 over that time period. And that's one reason we've had such a supersized bull market, really. And it's where rates peaked back here, early 80s. And it's not mere coincidence. We've had the strongest bull market in history because of that. And so it stands to reason we're going to go down. Here's our secular long-term bull market uptrend line. That's where we're going. But I'm getting away from what I was trying to cover. Let's get back to what I was going to do, and then we'll wrap this up. Told you I'd try not to make it too long. The Mag 7 we already covered, so you know what to watch there. Again, the common takeaway or the common theme is a lot of them at key support, potential divergences. If the bulls are going to pull off that new high scenario, I really think they need to step in here soon. And there's enough on the economic calendar, as I just showed you, that this should be a make or break week. So hopefully we'll know soon enough. Semis, You know, we've had multiple sell signals all along here and here and here and here. We're working our way down. Semis just hit their 200-day moving average today, so that's worth noting. There's stocks. The 200-day moving averages, typically in a bull trend, you're above them, and in a bear trend like this is, and that acts as support in a bull trend. So these were bearish trends or corrections. Let me use another. We crossed below the 200s. I should have mentioned they're in red and blue, the 200 simple and exponential. Here they are along here. Bull trend, and you lost them. We were in a bear trend all the way here. Got rejected on rallies back to those 200 days, and you finally took them out here, and they've acted as support since. And so this is the 200 simple. I'm sorry, exponential we're at, and the simple is just below it. So again, another key sector at support. But back here, you know, if you were buying that, you know, it's these, you know, when I turn on all the lines, why do I think those levels will eventually go? And here's my clean board here. Well, for the same reasons I thought, and we were short back here. Negative divergence at the highs was a catalyst for this whole drop here. And now we had negative divergence at the high, and then we went on to break the primary uptrend line. And so that's it. So maybe we have a counter trend rally now, maybe not. But I think we're going a lot lower. So that's one sector. I told you we would look at the banks. Let's look at XLF. We had a breakdown of that symmetrical triangle pattern today. Let me see if there's my clean board. I have a couple variations of it, but there's your primary downtrend line in XLF, the financial sector ETF. That's capped all advances since this bear market started. Make no mistake about it, by most metrics, we're still in a bear market, although I will give it credit. We have higher, it's more of a questionable, let's just say. We're well down below the bull market highs, and we keep getting rejected on the downtrend line, especially with a impulsive rejection off the last test of it right there, right? And then we took out this uptrend line here, and you have an uptrend line here, and my other board has this one right here. I have this trend line here, which we took out today. So that's, and also some price support there. And we're just going to rifle through the top components. We won't do them all, as I mentioned earlier. This is a very important one. This is Visa. And again, I told you earlier in the video earlier today, all you have to do is, you know, take any charting platform, compare the S&P 500, overlay the two, and you'll see that they move in lockstep. So, and more importantly, it's broken down. If you just take this on its purest form, forget about what you think is going to happen to the market, what you think the economy is going to, what you think the Fed or the federal government might do in an election year. I've heard it all. You know, take this on face value. It is a breakdown, and unless that breakdown fails, what makes it fail? A recovery, solid recovery back above the trend line. So maybe we did just hit the 200 days. So maybe we do rally. Maybe the economic data causes a rally this week, and we go and back test, and that'll be your next objective short on a back test of the trend line or a rejection off of it. Otherwise, if you go back up above the trend line, that's where you want to cover those shorts. But it's a breakdown, and by the scope of this pattern, it's only just getting started. Does not satisfy the measured target for that big wedge right there. And JP Morgan, king of all banks right here, big support, already broke down below the uptrend line right there, following the divergent high, following the minor trend line break. That's sell signal 1, sell signal 2, breakdown back test. So if we break this level, you know my targets. One to watch. And again, another one, a big important, very important stock for the stock market, especially the S&P 500, and for the economy, mind you, right at support right there. So that's the common theme, guys. This is why I do these long-winded videos. It's not one stock or two stocks. It's not as simple as is the S&P. You know, today the S&P 500 broke below a trend line, but QQQ closed on a horizontal price support. So what do you do? Which way do you? Well, you can tell you that, I can tell you a lot of other key stocks closed on support. So if we go much lower, those support levels go. And then the next levels they're going to have are the 200-day moving averages. But it's going to increase the odds that this will go down to hit my targets. And if they do, you will hear, I promise you, you see JP Morgan coming down to my targets here, especially my current fourth target, and I may add additional ones later on. you'll hear 180 on TV, whereas in the last, especially a few weeks back, they had written off the whole bear market thing, talking about not if the market was going to make new highs, but when, and they went away from going from hard landing talk to soft landing to then no landing, and now we're back to at least soft landing or maybe even a hard landing. So the narrative will change on TV. There's MasterCard. Again, I covered this one earlier. Breakdown, solid breakdown, sell signal, failure of the triple top highs right there. Everything else I covered earlier. Berkshire is now broken down, also followed suit. So there it is, guys. All these, the banks are breaking down. There's Bank America, one of the largest banks in the world. Boom, boom, boom. Bear market downtrend line, rejection. Had a little triangle pattern going here. It broke to the downside. So that tends to indicate the next direction is going to be to the downside. The next major trend. Morgan Stanley broke down today. SPGI is S&P Global. Solid breakdown recently, but it closed right on support. And I haven't even gotten to the long term. I go to the long term charts, and I'm seeing a lot of these either getting very close to, or in some cases already below their primary bull market uptrend lines. So, including SPGI right here. Okay, I'm going to stop the video here. I posted some commentary and charts on natural gas. That was at support. We all know crude's still going up. Big divergences. I think crude upside's probably limited unless we get a blow off top soon. That's possible. So don't get married to a short position. It's not an all-in moment yet, but I did give you targets on it recently, and I still maintain those targets. That was on the 60-minute chart. Yeah, it was. We're still off that divergent high, and the breakdown's still intact. There's our wedge pattern, and there's a downtrend line that if it pops, it might want to run up and put in another marginal new yet divergent high. As of now, that is the high. Just like the stock market, there's our downtrend line, support S1, support 1, and then those targets I gave you recently. Okay, all right, guys, I'm going to wrap it up here, and the things to watch, both price levels on the major indexes, the key sectors, those key stocks, and the divergences, and also the economic calendar. We've got a lot on the calendar this week up through Thursday, so it should be Thursday morning with GDP and the employment numbers out of the way. We'll probably have a good idea whether the bulls are going to be able to pull it off and either rally off these support levels we're at now, or if they break down tomorrow or Wednesday, if that's going to be a false breakdown, a whipsaw, and we're going to shoot back above there, the catalyst will probably come Thursday unless there's something that comes out of the blue that's not on the calendars. Like I said, I've got a whole bunch of yellow flags everywhere else. That was the other video. Any one of those things could suddenly start to become important to the financial markets. So keep an eye on those things as well. Alrighty, this has been Randy Finney with Right Side of the Chart. Have a great day.